Welcome, everyone. We will be starting very shortly. We are waiting for everyone to arrive. Welcome. Welcome, everyone. I'm Christina Tora. I am the Chief Market Development Officer at the GSG Impact. We are actually today launching our new brand. So it's a very exciting moment in time to have this webinar. Welcome to everyone. So this meeting will discuss how we increase private sector investment to meet the sustainable development goals in emerging markets. Thank you for joining this webinar, and we will be welcoming today some of the most prominent leaders in this space to share their thoughts with you on this topic. So really, thank you for joining us, and I would like to now hand over to our chair, Nick Hurd, Chair of GSG Impact, for welcoming remarks. Welcome, Nick.
Chris, thank you so much, and a big welcome to over 160 participants and counting. Let me just very briefly introduce GSG Impact for those of you who may not know us or understand our motivation for hosting this webinar. Basically, we exist to help accelerate a transformative shift of resource to activity that has a positive impact on the SDGs and climate goals. And over the last 10 years, we have developed a community of national partners in over 50 countries, of which 50% are in so-called emerging and developing economies. And on the way, we have stood up some important initiatives such as the Impact Task Force with the support of the G7 presidency, the Education Outcomes Fund, the International Foundation for Valuing Impact. And I think as chair that our value proposition lies in our ability to connect the global to the local and to accelerate the flows of information and ideas and innovation across borders and across sectors. And in that process, build coalitions of practical action. And this important webinar flows from a call to action that was delivered by our Impact Task Force, which I also chair. As I said, we were set up with the support of the British government that had the G7 presidency at the time. And we were asked to look at, with fresh eyes, at an old exam question, which is, how do we accelerate the volume and effectiveness of private capital looking to make a positive social environmental impact, particularly in low middle income countries. And part of our assessment focused on the critical role of DFIs and multilateral institutions. And like others, we pointed to their low rates of mobilization of private capital. We called on their shareholders to be much clearer in their mandate to give greater priority to mobilization and to empower those organizations to do more. Like others, we focused on the critical role of catalytic capital, which we define broadly, capital that's in a position to help adjust the risk for other actors. And, you know, we said it would be wonderful if we had more of this capital to deploy, and we call for that. But in the real world, it's going to be limited, and it needs to be treated as a precious resource. And we call for a new approach that was much more collaborative between those in a position to deploy catalytic capital, much more collaborative between international partners, because our observation is too often they act in silos, but also critically much more collaborative between international and national actors in the economies where we're hoping to mobilize capital into, with actors that are much closer to the ground truth and the market realities. And we said, wouldn't it be good if this approach was much better informed by a greater common understanding of what works and what doesn't work in terms of deploying catalytic capital in different contexts. And then we zeroed in on a specific issue, a really important issue, which is access to finance for SMEs, however you define it. And we said, look, this is a really important issue, particularly in emerging economies, for reasons I think many people on this call will understand, in terms of their impact on jobs in the formal economy, in terms of their impact on growth, in terms of their impact on the distribution of goods and services in isolated communities. Here's an issue that matters. Here's a long-standing challenge, because the issue of access to finance has been tabled as a big barrier for a long time. So clearly we haven't cracked this challenge. Surely this is an area where a new approach is required that builds on the principles we tried to identify: a collaborative approach from the start, a conversation across borders, bringing together different investor types, that starts with a better understanding of what we have learned from doing over decades in order to understand the success factors that should underpin new blueprints for action, new vehicles for mobilizing different types of capital. So I'm absolutely delighted that that call to action has been picked up by Chris and the team, and really grateful to all the partners, the knowledge partners, the funding partners, the development partners that have shown leadership in stepping up and supporting this initiative and the working group that we are launching today. And I really hope that this webinar is, and what flows from it critically, is extremely successful and productive. And with that, Chris, I hand it back to you.
Thank you so much, Nick. Thank you. And let me build on the excellent comments that you just made. So, as Nick explained, we've been running the Impact Task Force. And so last year, we really wanted to dive deeper into what has happened in terms of capital mobilization for the SDGs in the past 2 years since our first Impact Task Force report, where we really looked at this issue. So we scanned the horizon, we talked to hundreds of experts, and we came up with the report, which is called Time to Accelerate, because we believe that even though progress has happened, not enough of it has happened. So let me present you some of the key messages that we have come up with, and then leading to this new initiative that we're launching today. So we looked really into how can we realize the full potential of DFIs and multilateral development banks to mobilize private investments for positive impact on the SDGs and a just transition in emerging markets. We do believe that all of us have to work together to achieve these objectives. But we have realized through this work and through all our work previously that development finance institutions, and well, I'm going to refer to them in general as DFIs, including multilateral development banks and also sometimes public development banks. They have a really, really important key role to play to act as catalysts to help us unlock more private capital, which is so desperately needed for financing the SDGs. As you know, we have a 4 trillion annual gap of finance for them. So the first chapter had been looking at how can we meet the SDGs and a just transition, and looking at what progress has happened. Unfortunately, what we have seen is that the numbers are not great. The target is moving further away. Even though climate finance in general has grown to be 1 trillion annually, we still subsidize fossil fuels at a level of 7 trillion a year. It's probably too much, certainly too much. So there is an effort to be done. The other challenge is that whatever climate finance or SDG finance is existing, it's not going where it's needed most. At the moment, only 13% is going to emerging markets directly. It's mostly at the moment captured by developed markets, and the numbers have been decreasing. So the outlook is a little bit gloomy. So we've reflected really on what are the easiest steps that we can take to move forward. The most important recommendation is we suggest that we should be moving to having a narrative of opportunity and looking at what are the opportunities that we can highlight so that investors take a different approach and have a different perception of the opportunities that do exist in emerging markets. One of them, and it has been a really incredible market to watch, even since then we published our report, this market has grown by 1 trillion. So today, the green social sustainability and sustainability-linked bonds market has grown to be a nearly 5 trillion marketplace overall. And that's a huge opportunity to attract investors that have the potential to scale the flow of finance for emerging markets. Of course, a lot has to be done for that to happen, but it's a massive opportunity. The second is the fact that the market of climate adaptation will become a 2 trillion market per year in 2 years. And that's significant too. The third one is the number of opportunities that do already exist in a number of markets. So UNDP has mapped several of these opportunities. 600 opportunities are present on their SDG investment platform. And they really show exactly where investors can go with what kind of risk return expectations to have the best impact in emerging markets. I also want to highlight 2 other opportunities or solutions that have come through. One is the Just Finance Just Transition Investment Challenge by the Impact Investment Institute, our UK national partner. That represents today 5 trillion of assets under management. So investors that have committed to investing for the just transition and who are working together on implementing those criteria. And the second other highlight I want to make is a recently published report by the Loudest Foundation that has highlighted and mapped 600 just transition initiatives happening all around the world. So a lot is happening and opportunities are already at our doorstep. Development finance institutions have an incredibly important role to play in making all of this happen and accelerate. But the starting point is also, helping us to see how we can progress and where we can start from. Private capital mobilization has not really progressed in the last 5 years. Development finance institutions are usually mobilizing less than $1 for every dollar invested, and in low-income countries, it's even harder. One of the reasons is that only 18% of the instruments that they deploy have private capital mobilization as a target. But more importantly, what we are seeing is that development finance institutions face a trilemma. We are asking them very different things, which are usually mutually exclusive. We're asking them to invest in the poorest countries, to make money, and to mobilize private capital. So it's tough. Their job is really tough, and we need to support them in progressing towards mobilizing more private capital for where it's needed most. So our ambition, very ambitious, we want to collectively work to help them move from less than 1x to more than 10x of private capital mobilized. Really ambitious. For that, we want to help enable DFIs to move from originate to hold to originate to share. That will be challenging as well, and at least 4 different items can be helpful. One is mandates, targets, and incentives that will help DFIs to change. Business models and operations to evolve and to align to those new objectives. Pipeline development and structuration of deals that will by DFIs that will help investors come in easier. And finally, sometimes regulations are also preventing DFIs to mobilize private capital, and perhaps those can be helpful too if they're adopted. We are seeing, and we have been hearing from a number of experts and practitioners that a lot is already working to mobilize more and above average private capital. There are examples out there that we think are relatively easy to scale up or replicate, such as MIGA or the Private Infrastructure Development Group, PIDGE, and several others. So let's look at how that can be done. DFIs have a really important role to play because they can increase the use of blended finance and concessional finance. So that's something that works really well. We are seeing that for every dollar invested in concessional capital or blended finance solutions, $4 of commercial capital on average are mobilized, which is significantly more than in other kinds of deals. They can boost the use of guarantees, which is also mobilizing more than average. And finally, they have the ability to harness growing and increasing interest from institutional investors. They're really sitting in the middle of this hourglass, enabling the trickle-down effect from large asset owners all the way to where it's needed most, to SMEs and other organizations that can create impact in emerging markets. What we're seeing, however, is that the tools, the instruments that they have at their disposal are not enough used and not enough deployed. And therefore, the other kinds of solutions that are available or could be made available by, for example, asset managers are lacking. There is not enough of those that can invest at large scale into emerging markets. There is very few, for example, fund of funds that are investing in emerging markets. And so we're really calling for the attention to be put to these solutions that are either not enough in terms of quantity or not maximizing the impact that they could have. So we have also zoomed into, and that's really important to us, to what's happening in the different countries. And that's where the attention should turn. So pension funds, for example, are increasingly interested into investing in alternatives and investing into impact. A number of initiatives have been started, such as the Kenya Pension Fund Investment Consortium or the Asset Owners Forum in South Africa. Those are groups of pensions that are working together to look at how they can invest into real assets or the real economy, and working together to do co-investments, educating each other on the opportunities that are available. Similarly, our national partners in many countries, such as in Nigeria, in Ghana, in Zambia, are working already with the pension funds of their countries to show them the opportunities that are out there. One of the beautiful things is that pensions in Africa, for example, most of them have already the ability, the fiduciary ability to invest up to 10% of assets into alternatives. So regulations don't need to change. What needs to change is their practice, because at the moment, usually less than 0.1% of their investments are going to those asset classes. Another group of really important players in the markets are the public development banks. We don't talk enough about that group. However, it's a really important group of actors. There are more than 520 public development banks around the world. Collectively, they manage 23 trillion of assets. So they are the partners that should be in working with all of these different actors to support, to enable, to catalyze the private sector to come in to the impactful investment opportunities. So Domestic initiatives are underway, and where we see probably the most importance is around supporting SMEs. They make up usually up to 50% of GDP in many countries, oftentimes between 80 to 90% of businesses. And they, of course, some of them, I mean, there is a segmentation to be done on what we mean by SMEs, but many of them can have a huge impact on the SDGs. And so zooming into SME finance and how we improve SMEs' financial ability to grow is an essential lens that many of us need to adopt and improve. To support them, many new innovative funds are being set up. First-time fund managers are building very interesting models all around the world, and especially you can have a look at the Collaborative for Frontier Finance. They have an incredible network of those fund managers in Africa, and they are really the pioneers working on how to adapt best the finance to the needs of those impactful SMEs. Collectively, they represent, or they are raising 1.5 billion of capital at the moment. So they are waiting for many of you to come in and work with them. And I also want to zoom into what our national partners are doing, because they have really been assessing the needs of SME finance and also what needs to be done to achieve the SDGs in their markets. And they are building the solutions at scale that will be transformative for their markets. So you will hear from Hamdia later about what's happening in Ghana. Nigeria is building a 1 billion wholesale impact investment fund with already 50 million pledged from the government. Our partner in Zambia is building a 150 million credit risk guarantee scheme, working very actively with the Central Bank of Zambia. And these are very concrete solutions that will address many of the issues that we are talking about, because they will improve SME finance, there was circumvent currency risk, they will unlock domestic private capital because they're working with the pension funds in their markets, and they are the most adapted to what is happening locally, the needs that are happening locally. So what is, from our perspective, one of the most important things is to create the links in between all of the players and the national solutions built by these very active coalitions. So as a conclusion, we need to support and invest in domestic initiatives led by coalitions and for the markets in emerging markets. We also need to increase the supply of catalytic capital. Many really amazing initiatives such as the Catalytic Capital Consortium have proven that it works and that many innovative models can be built to attract significantly more private capital. To invest and deploy existing de-risking solutions, we don't need to reinvent the wheel. Many of the tools and instruments are already available. It's about deploying them at scale. Developing and implementing the mobilization strategies will be essential for all of the DFIs with ambitious targets. And finally, data and evidence. If it's released, we're very much hoping, praying, advocating for the GEMS database to become public good, to enable investors and other data points, actually, to enable investors to improve their risk perception and the risk analysis, and to develop a better understanding of how they can create impact in the markets. So what are we doing about it? We did a report. And so now today we are officially launching a very exciting new initiative, which is co-led with 3 DFIs, BII, DFC, and Norfund, which will have the purpose of providing recommendations as to which solutions work best, so that DFIs and public development banks can adopt those solutions to help increase the flow of capital, private capital towards the SDGs in emerging markets, with a very specific focus on ensuring that SMEs that create impact can benefit from it, and that their financing is made easier. So it's an 18-month project. Stay tuned for updates on this. And this will be, we will be updating the community about what we're finding on a regular basis. So it is time now for me to hand over to Hamdia Ismaila, the Managing Director of the Shigaba Fund of Funds and founding board member of Impact Invest in Ghana, our national partner in Ghana. She will present the Shigaba Fund of Funds as a concrete solution to mobilize private capital. Over to you, Hamdia.
Thank you, Chris, and good afternoon to everyone. My name is Hamdia. I am one of the co-founders of the Ghana NAB, the Impact Invest in Ghana. And right before we launched the Impact Invest in Ghana initiative, we looked at the economy, we looked at what was happening, and we thought that it was very important to begin to leverage private capital into impact. That is one of the core things we could do to achieve inclusive growth. So we narrowed down locally. We looked at the pension funds. Chris has already talked a lot about the pension funds in Africa, so I wouldn't be dwelling much about that. But what we realized was that there was just about 6 billion assets under management. And we also noted that the pensions industry is growing continuously. And then we realized that a chunk of these monies were into government securities. So our task was try to understand why it is so, and how we can leverage some of this money into the real sector, because we believe that supporting the real sector is a key way of achieving inclusive growth and also achieving the SDGs in most of what we do. So we engaged the pension funds, and a few things that came out to us was the fact that there were issues around liquidity events for them when it happens, because this asset class is being described as illiquid, and issues of return, because government was paying a lot higher return to them. And they also considered the real sector as a high risk. And so how are they going to put pension money in such a high risk investment? And so we engaged, and that was when we decided to come up with the Shigaba Fund of Funds, which Shigaba means Progress Fund. And we try to embed all these kinds of discussions we've had with the pensions into the design of the fund to make it attractive to the pension funds to put in money for us to build a real sector. So the Shigaba Fund of Funds is a 75 million fund looking to invest in fund managers investing across the West Africa region. So we are targeting 4 countries in West Africa, which is Ghana, Nigeria, Senegal, and Cote d'Ivoire, where the fund managers would be based, looking at, but they could invest across various countries in West Africa. So we focused it as a regional fund, and we wanted to build that and demonstrate that it is possible, we can get this done, and that we can actually leverage money locally. And based on some of the conversations we had with the pension funds and the requests that came in, we wanted to make them a bit more comfortable. So in the design, we put a two-step design with a catalytic layer, which is about 30% of the fund size, and then a commercial layer, which is 70% raising locally. So the fund is 70% local participation, 30% catalytic, to be able to manage the risk aspect of what the pension funds had raised, and also to be able to deal with the liquidity issues as and when they happened. So it is a permanent vehicle that allows us the flexibility to get the pension funds in. And when they have a liquidity event, they can leave, and we have a base with the catalytic layer that allows us to be able to meet our targets to the pension funds. So basically that's how the structure is. We are looking at key sectors around agriculture, agro-processing. We are looking at clean energy. We are looking at technology. We are looking at healthcare, education, and financial inclusion. So these are the key 7 sectors that we are looking at. And we are an SDG aligned impact fund. We are aligned to 9 goals. We have the cross-cutting goals of goal 1, 5, and 13. And then we have specific goals that the fund is going to be tracking. We just recently finished building our impact measurement system. And so we are currently fundraising. We are looking for potential catalytic investors to come on board and help us bring this fund to reality. The team is in place. The fund structure is complete, and we are currently speaking to investors. I think that I will just leave that here, and when there are further questions, then I could come up and respond to some of them. Thank you very much. Chris, back to you.
Thank you so much, Candia, and thank you for describing both the challenges, but also how you're addressing them, kind of point by point in the structuring. So I'm now going to hand over to our panelists and our panel. So Drew Van Glan, Executive Director of the Collaborative for Frontier Finance, one of our key strategic partners at GSG Impact, will lead this very insightful panel discussion on solutions and challenges for capital mobilization with a focus on SME finance. I do encourage all of you. I can see that there is already a number of questions and actually answers as well in the Q&A function of the webinar. So don't hesitate if you have questions to put them there. We will have time after the panel discussion to have an exchange and to discuss some of the points that are being raised in the Q&A. So go ahead, and Drew, over to you.
Christina, thank you. To Kurt as well. Thank you, and everybody so far. Thank you very much. I wanted to, first of all, just Drew Van Glan from the Collaborative for Frontier Finance. And as Christina says, we're partnered with the GSG and the NABs on this effort. And CFF itself is, I guess the way I simply put it is, we're razor focused on the issue of access to capital for small businesses in emerging markets. And we're a multi-stakeholder initiative with the belief that in our name, collaboration and collective action is critical. So that's why this call is so important. This panel is a perfect follow-on to the different discussions that you've been hearing so far. So, and I think this image that I want to keep bringing people back to, that the graphical image that Christina put forward, which was that hourglass and that kind of bottlenecking in the middle there, challenge for the sector of moving large capital to a very diverse set of small businesses around emerging markets doing lots of different kinds of businesses. And you heard Amdia speak to the fact that even in her fund, they'll look at 7 sectors, and you can imagine all the different businesses inside of 7 sectors. So that raises that heterogeneousness of the small business sector, raises its own interesting challenge, and we'll come back to talking about that with the panel. So I've got the pleasure here with the 4 panelists from 4 different DFIs, 4 major players in this, who, as have been described, are both the critical pieces of both the catalytic role and the capital mobilization role. So we're kind of weaving that discussion together today, knowing that we still need some innovative actions, but we also know that the end game here is, if you use IFC's number, that we've got the 5 trillion, put it up against some of the other numbers shown a few minutes ago, we've got a $5 trillion deficit in getting to small business finance. So clearly capital mobilization is needed. So we're going to go through a series of questions. I'll go around with the different panelists, and I'll let them describe themselves and organizations. But the first one is really just kind of a state of play. What are they seeing? What are their organizations doing with regards to the small business and moving into both catalytic and then capital mobilization. So why don't I start with Matt, if you don't mind, Matt, just to give us an update from your perspective at BII, and we'll go around from there.
Great. Well, thank you, Drew, it's a pleasure to be on the panel today and part of this initiative. So I'm Matt Robinson. I'm head of private capital mobilization at BII. But I thought actually I'd start with just trying to set out our journey at BII over the last decade or so in terms of supporting SMEs. And we're the UK's development finance institution, and we invest almost exclusively in Africa and South and Southeast Asia. And our journey actually in SME finance is very well described in a research paper that my colleagues, you can't see that, I'll put that in the chat, a couple of colleagues have put together, which is entitled How and Why We Finance SMEs. So let me sort of give a summary of it, really. I mean, first of all, we are about development impact through our capital, and the impact of SMEs in an economy is, as mentioned, is kind of completely integral, partly because they employ so many people, but partly because they also generate the businesses that become the large businesses, which themselves are huge sources of employment and productivity growth. And in lending to SMEs, there seems, I mean, as Drew said, very heterogeneous, but there are some common sort of barriers, I suppose. One is around information. So how do lenders get access to the SMEs track record? How expensive is it to find that information? How can the sort of instruments be tailored to SMEs' needs, because they don't necessarily have predictable revenues. They certainly don't have dollar revenues, and they are often looking to borrow for longer sort of tenors than banks and others are willing to provide. So in our journey, we've tried to overcome some of these barriers in different ways. And I think probably what we started by doing 10 years ago is sort of generally strengthening strong banks by helping to grow the balance sheets of banks, both through equity and debt, for general purpose lending, and big investments in things like RBL Bank in India and Axis Bank in Nigeria sort of 10 years ago speak to that. Sometimes we can do what's called tier 2 investments, which are particularly catalytic in helping the banks then raise other sources of debt, and mobilize, I suppose, other creditors. More latterly, we've gone into more directed lending, where we say we will provide you capital, bank, but we want you to use it for a defined purpose or use of proceeds. And quite often this has been for SMEs. And so we've done this with banks in Sri Lanka. We have done this also through risk sharing facilities. And we've helped to finance, for example, the Africa Guarantee Fund, which itself guarantees SME portfolios at a range of banks across Africa, which I think is a good example of trying to sort of generate more firepower for SME lending. And then most latterly of all, I suppose, we're getting deeper into the specialisms and particular blockages for SME finance. So partly that's about backing non-banks, in fact, non-bank financial institutions with sort of specialist products, whether it's things like invoice financing or receivable financing, and we've backed somebody called Time to do that, or fintech startups that help solve these informational gaps I mentioned at the beginning in terms of cheaper and faster assessment of would-be borrowers' sort of creditworthiness, which itself then lowers the cost and improves the terms of products for them. And we've also got into, I suppose, broader financial services for SMEs themselves, as opposed to just sort of capital. So things like payment systems, for example, that SMEs require to run their businesses, which is part of the broader array of financial services. That is something we've invested in through fintechs. And then our most sort of significant recent play of all is also something in Ghana, actually, just listening to to the last presentation, we have created a new company in Ghana called Ghana Growth Investment Partners, with $50 million of our own capital. And this is a company, a platform that will lend to SMEs in a more standardized way with less collateral needs and longer tenors and local currency, which is all trying to address the kind of need that we understand is so kind of often unmet with SME finance. And also like the last fund of funds, you know, it's looking to raise in future more of its capital and share its we're looking to share our shareholding with other local partners, particularly the pension fund industry in Ghana. But we hope that this platform is replicable in other countries, and we hope that through careful design of kind of the product and in some cases standardizing the lending process and the credit process, we can offer a product to SMEs that's not currently in the market and responds to some of their unmet needs. So we're quite excited about that. It's early days, but hopefully see that replicated elsewhere. So I'll stop there, but that gives just a summary of BII's journey, and I'll put this report I mentioned that 2 colleagues have written on our journey in the Q&A, so people can find it if helpful, and look forward to the discussion.
Matt, thanks, and appreciate the waving of the report. It is an excellent report, and I'm glad it's in the link for people to read. And really do recommend it. It's a good historical walk back of some of the challenges and some recognitions that we. And part of the reason for this call is we haven't achieved what we've been trying to do, and it's a frank discussion on some of those points, which is where we'll continue with that. Let me jump over the channel to the Netherlands and ask Winnie from FMO her perspectives on some of the programs that she's been leading there and where they're at, and some of the successes and challenges that have come across in the program that you've been spearheading.
Thanks, Drew. And thanks for having me on the panel. Very pleased to be here. I'm Winnie Waaije. I'm a business development officer working in FMO's blended finance team. So, like Drew just explained, FMO is the Dutch Development Bank. We have a mission to enable entrepreneurs to increase inclusive and sustainable prosperity in low and middle income countries. And our 2030 ambition is to maximize our impact on 3 SDGs, namely 8, 10, and 13, across our 3 focus sectors: agribusiness, energy, and financial institutions. And now, one of our key assumptions for our financial institution strategy is that we maximize our impact on supporting decent job creation and economic growth by targeting SMEs through financial intermediaries. Because, like Matt from BII and the ladies before here already highlighted it, MSMEs are the major share of employment and economic growth in developing countries. So it's essentially in our mandate to support them best we can. I also can agree with a lot of what Matt was just saying on the DFI's journey on SME financing. We see the same barriers for directly and indirectly increasing investment in this segment. So how do we as FMO go about these barriers and challenges? We aim to increase access to finance for SMEs through financial institutions, intermediaries, with investments not only from our own balance sheet, but also by dedicated blended finance and guarantee instruments, which is what my team does. So I'll highlight that, like Drew just asked me to. Examples of instruments are Massief, that's our financial inclusion fund that we manage on behalf of the Dutch government, the FMO Ventures program, and the Nazira program that we have set up with the support of the European Fund for Sustainable Development and the Dutch government. And that lets us look specifically on taking away the highest risk for financial intermediaries to invest in these more challenging segments and underserved groups. Additionally, as part of our 2030 strategy, we want to structurally approach what we call market creation. That is developing bankable opportunities in nascent and more fragile markets. And through this new line of business that we're currently still developing, but I want to highlight here, we want to pioneer and really enable ecosystem development and strengthen business development, also with SMEs. And to maximize that value creation and impact, we will work together with partners, stakeholders, third parties, civil society organizations, incubators, accelerators, business networks, and universities. That's a big mouthful, so we will be busy the coming years. And then let me zoom in on one of the instruments that I think is nice to highlight here for this audience. That's really helping us already to target underserved MSMEs in emerging markets. It's our risk-sharing facility, Nazira. And Nazira is an instrument that helps FMO to pass on a second loss guarantee given by the European Commission to local banks so they can reach new target groups that they would normally consider too risky for lending. And over the past 4 years of running this program, we have seen that the issue to reach these groups is more about risk appetite than liquidity. So a guarantee works perfectly because there you take away some of the maybe perceived risks of lending. Nazira helps to unlock financing for underserved SMEs that want to start or grow their business, including young and female or migrant entrepreneurs, agri-entrepreneurs that are small scale. And as we help these borrowers move from informal to the formal economy, they see their financing costs reduced and access to finance increased. So we received the initial 100 million euro guarantee instrument from the European Commission and have already leveraged a portfolio of 370 million euro with that. We've now 17 transactions in countries from neighboring Europe, European neighborhoods, and in sub-Saharan Africa. We're well on track on reaching the target of 500 million euro portfolio and aim to scale up. So we're going to increase the program, go global, and also increase our target groups. And that we'll do in the coming year. And we'll build it out to a 1 billion euro program. And that is because we simply see, like my three panelists have already highlighted, a significant demand for this. That's why we're going to scale up and continue the work that we started with Nazira. Okay, I think that's it from my side. Drew, back to you.
All right, Wendy, thank you. And again, I think what's interesting so far, we're hearing a combination of comments. One is attempting some new innovative approaches to different financial intermediaries, as well as this core issue of de-risking and addressing the perceived risks in these markets to advance the capital flows. And I love that one comment right now, the demand is not the problem. I think this is one of the fundamental starting points for all this. There's plenty of demand of quality investable appetite in these markets. It's getting the capital to them that we consistently see from the collaboratives lens. I'm going to go a little further south on the continent here, and Jose Luis, as the CEO of Cofidis, love to get your take on where you've been taking the organization, recent and your perspectives on this sector as we're discussing it. I think you're still on mute. Still on mute.
Yes. Yes. Hi, Drew. Well, I am in a hotel in Paris, so I don't know if you hear me well, because it seems that the Wi-Fi is not working too well. So, well, I will tell you, Spain is a quite complicated country for many things. Why Why should we do things simple if things could be complicated? So in our case, when we work with small and medium enterprises in developing countries, we have different organizations. And at the end, I am the chairman and CEO of one of them. There is another one that is working with us, that is the Spanish Agency for International Cooperation. We have a partnership in which we are the ones that structure and mobilize the resources and contribute to the structuring of the operations, while the money is contributed by them, but they also have things to say regarding the operations. Traditionally, we have been working in small and medium enterprise financing through the traditional microfinance way of working, and the other one has been historically the contribution to venture funds, to different type of equity funds with different purposes. Normally, we have been very active in Latin America and a little bit in the north of Africa, much less in the rest of the continent and in Asia. For the last few years, and it's something that has been a very interesting thing, because have put, at least for me, has been a proof of one of the problems that we confront every single day if we want to mobilize private resources, is how you structure operations that the risk well enough the common ground for the private sector to intervene. And that is not easy, because you have to put together a lot of agents. Agents that each one of us have our own restrictions, our own purposes, our own political will, our own capabilities, tolerance to risk, etc., etc. So for the last few years, we have been working in developing a program that has been extremely successful, that has been the Uruma Fund. The Uruma Fund is a fund to support small farmers in Africa and in Latin America and a little bit in Asia, in which we organize a structure in which with 10 million euros of fair losses contributed by the European Union, plus 20 million euros contributed by the Spanish Agency of International Cooperation, this is a total of 30 million euros of soft money. We were able to mobilize 90 million euros coming from both Allianz, the insurance company, the German insurance company, and CaixaBank, that is the second or the third Spanish bank, with a total for profit purposes in both cases, logically. The program has been extremely successful, has been deployed very fast, has been the results that we know from the assessment that we are doing of the investment seems to be performing very well. Later on, we enter in another process that has been a learning, a master's degree in how to deal with institutions. Is that not only we were working with the European Union institutions, that probably many of you know how cumbersome is working with them, we made got the ambition of working with Green Climate Fund. And this was a real challenge. We have been taking more than 4 years of negotiations with the Green Climate Fund. Not twice have been working with talking with the same person. The same person at the end of the line was changing every 3 months. So every few months we were in square one again to explain the project again and again to different people. At the end, we were able to close something that I consider a very interesting operation, that is the Quali Fund. This Quali Fund is a fund addressing financial needs of small farmers for adaptation to the effects of climate change. It's going to operate basically in Latin America, also in India, is basically because we are working through a fund, an impact fund called GAWA Capital, that is Spanish Impact Fund, and they have a big tradition of working not only in Latin America but also in India. So we are also working in certain regions in India. So here we are having money contributed up to 37 million 37 million euros of soft money coming from the European Commission and the Green Climate Fund. And we will be able to mobilize, we are being able to mobilize 230 million euros, additional euros, dollars, to support small farmers in, as I said, in Latin America and India, in the adaptation of their crops and productive technologies to climate change. The thing that I have, for me, has been very interesting, not only because we will be addressing the issues, but also in addressing some of the nuances that we have to confront whenever we want to mobilize. And is that we have to have a lot of patience to be able to accommodate restrictions and concerns of everybody that is playing the role. But at the end, I think it's worthy. Is, well, you have to spend a lot of money, a lot of time, a lot of resources, a lot of patience. But at the end, you, with relatively small amount of money, as I said, in that case, is 37 million euros, more or less soft money, being able to mobilize 230 million euros of real private money addressing to the needs of the small and medium enterprises in rural areas. Thank you very much.
Luis, thank you. And I really appreciate the frankness of, I think we all have good visions of where we want to see this money operate and get done, but how we get it done and the systems through which we have to work is something that I think, again, falls into that challenge in that bottleneck or that graphic of the hourglass. And I think it's a perfect segue in this question of learning and the term you use of the it was a master's degree in getting things done with complex organizations and agencies. And I want to now pass it over to Elizabeth Bogdavidson over at DFC as the VP of Impact and an executive there at DFC, a senior executive at DFC. I'm curious to build a little bit on that, but also very specifically where DFC has been a recent and where you see things.
Right. Well, thank you. It's a pleasure to be here and be part of this effort with GSG. But so DFC, I have to remind people, it's the U.S. International Development Finance Corporation. It's still the newest U.S. government agency. So we're coming up on a 5-year anniversary. It was launched in January 2020 with a very specific mandate to partner with the private sector to finance solutions to those critical challenges they're facing in the developing world. So DFC's strategy has changed and evolved and launched a new strategy in the end of January this year, and it's very focused on industry sectors and cross-cutting priorities of climate and economic empowerment. But one of our 5 priority sectors, in addition to health and ag and energy and infrastructure, is small business support and financial services. And this is specifically to really accelerate access to finance for SMEs or small businesses. And, you know, we employ a variety of financial tools, including direct loans and portfolio guarantees to address this sector. 40% of our overall portfolio. And last year, just for context, we committed $9.3 billion in 132 transactions, which year on year, we're really, you know, since 2020, really doubling it's very intentionally trying to double and to push much more money out through our financial institution. But 40% of that portfolio is invested through financial intermediaries, and we're partnering with financial intermediaries by really providing either longer-term loans to enable them to grow one or more of their portfolios to underserved regions or sectors and populations. But we're also, I think, effectively using our loan portfolio guarantees. This is the tool that really aims to increase access to finance by de-risking underbanked SMEs and sectors. And we now have 73 SME-focused loan portfolio guarantees. So these are provided on a portfolio of loans, and, you know, helpfully enable local financial institutions to extend local currency lending into often very capital constrained yet highly productive segments of economies such as agriculture and micro and small businesses and healthcare. For FIs with sufficient liquidity, but with reservations to lend, our guarantees can help to demonstrate that underserved sectors or borrower groups can be quite creditworthy. But I want to touch in my 30 seconds I know I have left, just on an initiative that speaks a bit to our efforts to really learn, but also to improve our SME finance. And so one of the responsibilities of my department is to conduct evaluations. And this is such an, it's a really critical component of our impact management and our learning activities. So we commission, thematic deep dives into a segment or a sector of DFC's portfolio. And in 2022, we really did that deep dive assessment and looked at the development performance of DFC's financial intermediary portfolio in Latin America to see if it was really increasing access to finance to SMEs and other targeted populations. And, it was pretty robust. We looked at 36 different loans that totaled $2.5 billion that made up 29 financial intermediaries in a number of different countries. And the sample ranged in size and impact themes. So we had a variety, for instance, 8 of the loans were gender focused, giving DFC, I think, an early indication of their achievements to date. And this was carried out by Dalberg Advisors, but we were really after some key questions. Did the financial intermediary achieve its development objective of growing its portfolio to the target clientele? Were DFC loan proceeds used to support these targeted portfolios? Was it likely that positive impacts would be sustained after DFC's loan matured? And the assessment outcomes were largely positive. Nearly 70% of our loans were achieving intended development outcomes, which were really to grow DFC's targeted portfolios. But some of the characteristics or structures that really tended to lead to success included that the FIs had both scale and were explicitly mission-driven to serve a well-defined underserved clientele. So these were the ones that were most likely to be able to demonstrate positive impacts. And projects that had technical assistance programs that expanded impact beyond the financial services that they provided were also key to success. And then some of the common characteristics of underperforming projects across this portfolio were the financial intermediary did not have a strategy or specific mission to serve a targeted clientele. So much of the reach was, incidental. The financial intermediary was not tracking loans to the target clientele in their systems, and therefore there was no evidence that our loan moved the needle in any way. And the DFC loan, if the DFC loan was small relative to the size of the target portfolio, we found that we had very limited additionality. And finally, if the financial intermediary was unaware of DFC's development objective and our reporting requirements, we were not seeing a lot of success. But we gleaned, we learned a lot of important things through this assessment, and it's public, but one thing we did learn is, our gender-focused 2X projects were not meeting the mark. For many FIs, the percentage share of women in the financial intermediaries portfolio did not change. And some of our, the 8 gender-specific loans, the financial intermediary fell below the average, lending to women entrepreneurs in the country. So we have really, we have been working to solve for these gaps that were identified through this assessment. And, we really tightened up over the last couple of years our due diligence to ensure that there is that strategic focus to serve that target clientele. We've tapped in very much to our technical assistance tool to support financial intermediaries and developing strategies, especially for serving women entrepreneurs. We've also used technical assistance to onboard a client voice technical assistance facility that's implemented by 60 Decibels to give us a better understanding and hopefully to start to articulate impact from that end borrower's perspective. And we've been, working to strengthen communication between our impact monitoring team and our financial intermediary clients so that our development objectives and, all of our criteria for reporting and how we're defining that baseline wise are quite clear. So that's some of the learnings that we've gained on this.
I think yourself and Jose Luis have really, in this last two comments, really given us some thoughts about the challenges, intentionality, and actually, Elizabeth, your comment right now brings me back to about 2014 and some work done by IDB and the impact lead there at the time, which I think was yourself, and then OPIC, which both focused on the early stage of impact investing, which was the word of intentionality. And that gets us into some of the complexities of behavioral economics and getting people to actually move into spaces that we want. In other words, moving capital itself is not going to be the only solution here. It is this learning of organizational challenges, be it at the, as Jose Luis was referencing, the complex multi-agency government or multi-government agencies like the Green Climate Fund or the EU, as well as all the way down to the financial intermediaries and their motivation. So that leads us with some great comments about things that have been going on and have been working. And I want to kind of turn this, and we've got only a few more minutes, but to come around to each of the panelists and speak a little bit about looking into the future. And I'll bring it over to Winnie to kind of kick off with this here. Yes, I'm going out of circle from the first round just to shake it up a little bit here. But Winnie, I know you comment about your Zero Fund and the accomplishments there and the scale you want to go to. Interesting. I'd love to weave in some of the thoughts you've been hearing now from the other panelists and from Hamdia earlier about challenges on the ground. And as you look forward into Zero going forward, any kind of reflections on what you're hearing and or already plans about, yeah, there are challenges, and how do we bridge some of those and continue to go to scale? So I'm curious with your efforts, some of your thoughts on that.
Yeah, so for the Zero program specifically, some of our lessons learned are that having such a guarantee program in place can only work if it goes hand in hand with technical assistance. Like Elizabeth just highlighted, it's very important. It's much needed to support local intermediaries to serve the new target groups that you want them to go to with this guarantee, or that you're wanting to enable them to go to. It can help develop new loan products for women entrepreneurs, or it can help improve the bank's risk management frameworks. What we also learned is that, also highlighted by one of the other panelists, is that a key ingredient for running a program like this well or successfully is that there is a strong data monitoring and modeling platform in place. So now that we're planning to scale our program, we already have one in place, but we want to improve it and make it more robust, to not only for the bank's own benefit, so they have a better overview of how the new part of their portfolio is performing, but also for our own impact measurements sake. So yeah, that platform that plays a super important role in gaining insights on the behavior of their end beneficiaries, and for us to really see what is the impact that we're having. And what we also learned is that different types of local financial intermediaries need different risk sharing mechanisms to effectively serve their clients. So we had a structure in place that is a second loss guarantee. It is very effective to serve regulated banks in developed markets, but it's more difficult in markets in fragile states, and also for smaller institutions like MFIs, they would better be served with other structures. Let's keep it simple. Yeah, and then I think what is also good to reflect on is that we want to increasingly work, like I was just highlighting, through our market creation efforts with partners on the ground, civil society organizations, incubators, accelerators, like Hamdia, for example, who I learned we are already close in contact with, and these are key for us to achieve our goals when it comes to serving the SME segment. So she's one of our key ecosystem building partners in Ghana.
This is great. I'm going to bring it over, Jose Luis, to you in a second. But what I'm also hearing in this is this need for the DFIs to increase its sense of, or its actual proximity to the players, whether and what mechanisms over time can help that. And I think it's great, and I think it's wonderful. And I'm glad you're my friend Samdia right here, because personally, what I've seen is the great role that Nick and the GSG team have been doing with the national advisory boards is bringing their voice more into this discussion from the local context. And so I think that weaving is really coming out for me as I hear the conversations. But Jose Luis, you challenge us at the big organizational level, but also you're hearing some other components. Curious to see as you look forward with COFIDES and your partner, as you described, with the other Spanish agencies, which is also another interesting lesson for other countries about the mutual coordination among government agencies that have different types of capital. Also an interesting component there. But love to hear your thoughts about where you think you see COFIDES moving forward in addressing in both deeper impact with the small businesses, but to the broader theme of increasing the amount of capital.
Yeah, I think two things. When you say something that I think is important, also Elizabeth says a little bit the same, is the relevance of technical assistance. But technical assistance, not in the traditional way in which we have been, at least many years ago, we were giving technical assistance to the intermediaries, normally for them to have more understanding of financial nuances and management of intermediaries. Well, this is still very important, but I think it's important to invest in how you design the transactions, because you have, on the one hand, to the risk in the transaction, but you have to minimize the amount of public money that you put in the market, so that there is private people willing to accept risks. So here is a very complicated thing, an element in which you have to is trial and error. Is how much money is the minimum amount of money that you have to provide to the design of the transaction, but for the transaction to operate and not be redundant, the amount of money that you send that you transfer to the private intermediary. Is what one is saying is, what is the first loss or second loss guarantees that you contribute, how you design, how you structure that. So here there is a lot of money that you have to use. It's sink money, it's money that you have to contribute to the design of the structure, and that is not easy. It's not easy at all to find people capable of structuring the operations the right way. On the other hand, all of us have been learning all along our lives that we are talking about impact. So as Elizabeth was saying, I want to know where the money is going and what effects it's doing, who is benefiting out of the money that is in the transaction. So this that also imposes on the intermediaries and on the beneficiaries the need to report, the need to learn how to report according to the lines of the people that are contributing the resources. So here is what I think is a lot of technical assistance is required, and we have to be capable of designing technical assistance programs that are suitable to the type of programs that we are doing. I think that in the future, we have also to develop new intermediaries. My feeling at least is that whenever we find a project, all of us are putting money in an intermediary that we like. And so probably we have to diversify the amount of intermediaries that we have out of there. and that this is a challenge for all of us. It's something that we have to pull resources and to pull abilities to develop intermediaries.
These are some great comments, and I really appreciate some of the thoughts here. And this new intermediary comment, and I think that's one of the reasons why Nick had asked Hamdia to present earlier, because what she's putting forward is a local fund of funders, which we haven't really seen many of these kinds of vehicles run by local players. And that to me is an illustration of a step forward in this, people that know specific challenges in the local market and getting them the capital than maybe some of the more traditional pathways. And this issue of design, I'm going to come back to it on our last question, but before I get to that, I'm going to bring it over to Matt. Matt, your mandate, if I understand it at BII, is all about capital mobilization, is how to really move big monies into the sector. And as you've been hearing the different challenges and knowing where BII is at, I'm curious to hear your thoughts of what are the steps or gaps that we need to cross over from where you sit, so that you're busy as anything with that topic of moving big capital.
Yeah, well, look, I think maybe being totally candid, it depends who you're trying to mobilize. And if you're trying to mobilize Western, Northern European, American insurance companies, who have very little emerging market allocation at all, then jumping them straight to SME finance in Africa is not going to be the natural first step. You might get them into broad portfolios of emerging market FIs in general for whatever purpose, and maybe some infrastructure. So I think it's important to sort of get horses for courses in this debate. And so if we're talking about SME finance particularly, we have to sort of recognize there's only a subset of the kind of capital market that's ready to do that. I think, as first presentation hinted at, the key probably is in local investors. Pension funds in Africa, for example, are growing very fast, partly through policy, partly through demographics. SMEs need local currency. It needs people who have country risk appetite, and all this stuff is easier for a in-country investor than it is for an international investor. I am not a total expert in sort of local capital markets there, but I think there are clearly some policy changes that can help, and there have been reforms recently in at least Ghana and South Africa to introduce greater sort of maximum ceilings in terms of real asset allocation. I guess the next step would be minimum floors, which is a little bit more kind of directive. That's one thing. I think, as other commenters have mentioned, intermediation is key. So we're playing our role there with Ghana Investment Partners. It sounds like Sigaba is playing that role, and you need someone to break up the big chunks, even that African pension funds would represent, and intermediate them down to even banks, frankly, and FIs, and certainly into individual SME businesses. And then thirdly, I suppose you need the broader macro monetary policy environment to be right. And the other kind of thing to be really candid about is it's hard to get real economy activity going when T-bills are paying 15%. Because that's nominally the risk-free alternative. So that is a barrier in some countries, quite a lot of countries, and that withholds not just for SME finance, but finance in a lot of other kind of productive sectors. So, mixture of some solutions and further barriers / home truths, I suppose.
If it were easy, we'd all be sitting on the beach. And basically appropriate season for anyone. So no thanks for the honest comments about what it's taking to scale. Interestingly, on the policy issue, completely understand that. And one of the discussions I know that the NABs are looking at in Zambia is how to deal with the regulatory issues with the central bank, to the one that Christina mentioned earlier about getting, not only is the issue of just cost of capital an issue, but is the regulatory allocations of risk capital by banks to highly discourage small business financing. So how can that be? And that's one of the initiatives being done by the Zambia NAB right now. And this issue of pension funds, again, another great one. And I think this all leads back to, Elizabeth, I'm going to bring it back and we'll wrap up here because I know we're kind of coming up to time here, and then we'll go into Christina leading a TNA. And I think there are now 28 listed here, some of which have been answered in part. But Elizabeth, you've heard a lot of things and a lot about learning, and I think these are issues that are very central to you, and DFC itself has been leaning in of recent to really think about some of these. So just kind of your recap on two things. One, about these different learning agendas and how to think forward, and then collectively your thoughts about the DFIs, as a unit or as a group, collectively trying to push the needle forward on these multiple topics that are coming up today.
Yeah, I mean, a key part of our mandate, and certainly the mandate of all of my colleagues here on this panel, is to mobilize private capital. And we know that such a substantial source of that capital is local capital providers who have that deep knowledge of their home markets and local actors. But Jose picked up, and we feel this so intensively, that there's such a growing, external attention, but a lot of pressure on DFIs to take more risk and to catalyze investments and to address, persistent market failures, and how to have that potential to generate that outsized impact that we're all shooting for. So I have to say, Drew, I'll talk a little bit about our new Office of Catalytic Investments, because I think it really speaks to the pressures that we've been experiencing and how we're trying to land some of those pressures with practical kind of outcome solutions. So, and I have to say, we've been one great thing about being a new development finance institution is that you can really leapfrog and learn from your peers. And so BII's experience with their Catalyst portfolio really helped to inspire our new Office of Catalytic Investments. And this was, very much informed as well by evaluations that we did of OPIC. The Overseas Private Investment Corporation was our predecessor organization that we supercharged. But by looking at an evaluation of a portfolio of impact and innovation from that predecessor organization and our current portfolio, we were able to compile a bunch of lessons and experience in investing in early stage and high impact and high risk enterprises. So we've really, I think, by launching as one of our core origination offices a new Office of Catalytic Investment, we're really underscoring our commitment, I think, to increasing the agency's ability to take that additional strategic risk, really, but with the pursuit of impact. And we, the objective is not to create a silo for catalytic work, but rather to encourage catalytic transactions across our product line and across our organization, all of our industry sectors. So we're right now, this was launched at the end of January, it's just coming together, but we're working on developing an investment approval process that allows for that, more strategic risk taking. We're developing new standards to deploy concessionary capital, building off of a lot of experience from our peers. We're putting, obviously, in place a good learning agenda to scale some of these successful innovative structures that we're learning from external parties, but also gaining inside DFC. And we are working very carefully to partner and deploy technical assistance to support new structures. And it's fun for me to see Handia and hear Christina talk about the work of GSG Impact, where we're really working to partner, to provide technical assistance support to help shape, structure some of these new catalytic vehicles that we heard about not only in Ghana, but also in Nigeria and Zambia. But technical assistance is also coming to play to support some of our more developmental clients that really need, basic business and commercial advisory support that's focused on improving operations, that also need to enhance their environmental and social systems to meet international performance standards requirements, and to develop some of that needed impact reporting. So the ambition of this new office, and sort of, I think it brings together a number of threads that we've been listening to today, like what is our role here for, accelerating volume and effectiveness of private capital, but how do we sort of open our risk aperture? So it's really it's to increase DFC's use of catalytic capital and very much to mobilize more private capital at the local level, but also to grow our portfolio of innovative projects that have a very intentionally high developmental impact. So that's a preview of that.
Great. I know we're at, as I said, we're at some almost 30 questions in the Q&A, and I'm sure there are other ones in people's minds. And I'm going to pass this over to Christina, but I think I just want to summarize with one observation is I think I'm hearing a number of common themes, both in opportunities and challenges. I'm also hearing what I think is, for me, who I get the chance to speak with many of these agencies, new things from each of you that I imagine are new for you, each of you, about each other, what you're each pursuing and what the challenges. So hopefully, and this is, I think, the theme that where Christina really wants with building up the working group that she discussed, is that this is one of the first steps towards a more collective recognition of, okay, how do we get green, share knowledge on what it takes to get green finance fund to do more so that the next agency isn't spending 4 years, was that what it was, Jose Luis? And how do we accelerate that? Or the issues of how do we get pension funds in more, or the intentionality alignments, and et cetera. So I throw that kind of open challenge to the DFIs as we go forward, that this is, to me, a great opportunity of shared discussion. Now it's about further shared learnings. I think it would be wonderful to see this go forward. But Christina, let me pass it back to you now. But again, panels, thank you very much. For me, again, I work with this all day long. It was great to hear your comments and really reconfirming of where people are really rolling up their sleeves and trying to get things done. But as Matt said, there's a lot more to do to get to the scale levels that we need to be doing.
Yeah, thank you so much, Drew, and thank you to the panelists. Please don't leave, because we're now entering into the Q&A moment of the conversation. I'm not sure we actually need the slide for the Q&A. For those who have been inserting some questions and sometimes also answering questions, thank you. For those who haven't, you can vote for the question that you want to see discussed now. And thanks, Drew, for your conclusion. I wanted to bring in another question, which was for Hamdia, but I will bring first this other question because it builds on your conclusion and builds on many things that has just been said. So how can different DFIs work together to create a pool of catalytic capital, concessional guarantees, and so on, that will enable mobilization of private capital? So really the question of collaboration between the DFIs. And I will add to that, or weave into that, a question from someone else who was asking, how do we best bring in family offices and high net worth in this conversation? Who wants to start?
I mean, I can say that, as I mentioned, DFC is a new player on the scene, and we have really benefited from close collaboration to launch our impact management practice. It was very much a collective of like-minded peer institutions to really help inform that, and then being part of a collaborative. Our catalytic capital was benefited tremendously from following experiences with BII and close conversations with many that have been part of that construct. I think our intentionality to really work on a learning agenda around private capital mobilization, particularly at the local level, around sharing experiences and models that are working, is very much part of what we're launching and trying to pursue. So all of this would not really be possible without sort of collaborating and sort of cross-referencing and understanding the experiences that have been successful and the experiences that have not been successful. What do we need to do differently, clearly? So I feel like there's a lot already in train and a lot of interest in working closely together right now.
Yes, absolutely. And that's also the purpose of the new working group that we're launching together. So thank you for being one of our co-hosts. Jose Luis. Oh, you are on mute. If you can just unmute yourself.
You have said two questions. One is collaboration among DFIs, and well, in Europe with all the complexities, but still the EDFI, European Development Finance Institutions, and also with the European Commission, and also with the recent collaboration with the DFC and the Canadians. There are movements towards collaborating and exchanging experiences and pooling resources and so on and so forth. So, well, these things don't happen from one day to the other, but I think there is a sense of collaboration and willingness to collaborate and learn. Also, regarding, you said something very interesting, that is family offices, how you move money of the philanthropy, family offices, even it's crazy to talk about what is sovereign funds, sovereign wealth funds. I think that this is a matter of, in the case of the sovereign wealth funds, have been, well, COFIDES is also the sovereign wealth fund of Spain, one, because we play different type of hats. It doesn't mean that I fly in private planes like they fly, some of these people fly. But the reality is that there is all along the line of climate financing, there is a general concern about. So whenever you go to the Gulf countries, for instance, and you talk to these people of the sovereign wealth funds, all of them have the concern of how, if we want to address an issue that is relevant, I don't say that is the most relevant issue for them, but for them it's also relevant. And if we want to address the issue of climate change, we have to collaborate with actors that operate in developing countries. And to work with them in that, they have to be able, or all of us have to be able to structure operations and the risk operations to a level in which you can add the development finance institutions, the multilateral development banks, the sovereign wealth funds, and also the family offices that are willing to have projects that are the risk enough for them to have a willingness to invest or to share risk in the project. Of course, as before was saying by our colleague from BII, this is very challenging whenever interest rates make that the threshold for making attractive investment in risky project is very high. But anyway, it's something that we have to live with us, and if not, as it was said before by Drew, we'll be on the beach. So
Thanks, Jose Luis. Matt.
I just want to say quickly on the collaboration point. It's not limited to DFIs and MDBs. I think the private sector and private sector asset managers themselves may be better at structuring and distributing products that make use of what DFIs and MDBs are best at. What DFIs and MDBs are best at is originating impactful assets in emerging markets. They're not necessarily best at knowing how to package those up and distribute them to investors. So, you know, in the last couple of years alone, you know, people like the ILX fund have built multi-originator models that do that, and there are others thinking of doing the same. And I think that could also be part of the way forward in terms of making the most of multiple DFIs.
Yeah, absolutely. I mean, great point. And the ILX fund has been a pioneer in this space that's been highlighted many times as a great example for solving some of the issues. Drew, you had your hand up as well.
I just wanted to comment that, Jose Luis, if you did mention earlier that you're in Paris right now, the INP investments, who we've all worked fairly extensively, who's headquartered in Paris, are actually looking exactly at this issue of how to map and leverage family offices. So if you got the minute, just a little quick suggestion of using some of your time, because it's exactly a theme that is underway, and it's just being launched as we speak, is how can we be more proactive bringing family offices into these discussions.
thank you.
Yes, great highlight. So I'm going to turn to Hamdia because there were a number of questions in the chat for Hamdia. Hamdia, I see that you already answered some of them, but there was one you didn't, and perhaps you can also touch on the other answers that you gave. So with respect to the Ghana Fund of Fund, by liquidity, do you mean the pension funds will have rights of redemption? And if so, over what period of time? Will this also be a percentage of capital committed or net value?
Thank you, Christine. So I've been responding to some of the questions, and this is a very good one. There's a lock-in period for the pensions as we negotiate when they come on, and the redemption right to be negotiated as and when we get to sign in. But depend upon what time they are getting out, it could be at committed capital or it could be at the NAV based on how we all discuss pay other investors also on the schedule. Thank you.
Thanks, Hamdia. Very clear. There have been a number of questions around catalytic capital, so I will read out another one of them. So I understand that the focus of your work has been on DFIs as providers of catalytic capital. Well, also others have been providing catalytic capital. But anyway, given the barriers DFIs often face, some of the catalytic capital needs to come from other sources. Have you come across any examples for DFIs or development agencies mobilizing and collaborating with private catalytic capital providers to get their help in mobilizing more commercial capital? Elizabeth, go ahead.
Actually, I was going to point to Winnie because I think there's an SDG fund it's quite relevant that I'm not nearly as familiar with, that FMO has been so important in seeding and enabling. But Winnie, that might be part of your mix. I don't know.
No, so Elizabeth, I think you're a little bit ahead of me there. I just came back from maternity leave this week, so I'm not up to speed with this yet. So if you can share about it, then please do.
No, not specifically, but Jose, you jump in.
No.
I think we're all talking about the 1 billion SDG loan funds that was launched by FMO in December or November, I don't remember. So really, you were maybe on at that time. So congratulations. There was this other baby that was born, a very massive one, which was set up by FMO. Drew, do you want to say a few words on that?
Well, I was going to speak really to the broader question of, has there been other forms of catalytic capital coming in to work with it? And I think a good example of recent is the MasterCard Africa Growth Fund, which is specifically looking at financing emerging funds that specialize in small business finance. And they are bringing a kind of a first round of higher risk tolerant capital with the intentionality of bringing other players like DFIs alongside of them. So that's an example of where partnerships across different risk capacity is happening. And I think we would love to see more of those kinds of programs happen where the DFIs are partnered with other players that specifically can take on a little more risk or address one that I know the DFIs wrestle with as well, which is this issue that has come up repeatedly about technical assistance and the role of that. And I think each one of the speakers spoke to that. Jose Luis in particular on that. And I think one of the challenges for DFIs is they need somebody to help bring some of that capital. And again, MasterCard in that program is bringing a substantial amount of money, not only for risk investing, but also for the technical assistance. I think it's a good example of what we hope to see more of happening out there.
Thanks, Drew. Another question that, well, I mean, Elizabeth, you kind of addressed the question in some of your remarks, but perhaps others want to come in or you want to add anything else, which is around the question of measurement and monitoring of the availability of funding for SMEs. So what is the effect of how impact delivery is measured and monitored on the availability of funding for SMEs? In particular, the whole goal cannot be just to fund just any SME, but SMEs who clearly deliver positive impact on few key domains and limit impact risk on others. This requires impact measurement and monitoring. So I don't know who wants to share thoughts on this quite a significant dimension. Matt, you've had also a lot of kind of M&E work done at BII on how you deliver your impact. Do you want to share some thoughts on that?
Yeah, well, sure. So I mean, I suppose the answer is that there are layers of ways to assess impact. I mean, we obviously need a view going into an investment. We need to track that investment at the sort of at the investment level during its lifetime. But I suppose kind of the economists and the evaluators amongst us will want more than that and want to see the impact of a constellation of investments in, say, an economy or a sector, and how they together sort of create long-term effects like productivity growth or poverty reduction. So I suppose at BII we try to have efforts at all points of that chain, recognizing that some take, some give you an instant answer at the beginning of it, and others take years before you can know whether something's working. But we need to do it all really to sort of see the totality of impact. So I'm not sure if that answered your question, Christina, because it was a broad question, but I guess there's no one single answer to it.
Yeah, and I think that what you point to is the specificity and the sophistication into which you can go to really know what works in the different contexts. Drew.
Just jumping in again a little here, building on an example a little bit that Elizabeth mentioned about the work that they've been doing with 60 decibels, which I believe is somewhat at the early stages, so still waiting for some of the results from it. But a comparative analysis was to think about it. It was about 2 years ago, 60 decibels partnered with an impact investing fund for small businesses out of East Africa, Balloon Ventures, and they did a survey of the impact with the workers, the employees. So I think there's a real interesting template there. But one of the challenges we will have with all of this when we release, especially with small businesses, is making it relevant. And again, what I thought was really interesting with the report was 60 decibels. It got to not just numbers, how many people you employ, but was it really changing the trajectory of their lives, their career paths, and things like that, which I think is what we really think about when we think about job improvements. Is it easy to do? And that's always a tough one thing to do. And with that is the cost effectiveness. And then last is using it for informing decisions. So rather than just putting it up on a shelf or whatever, but rather what does it do to change the way we're engaging? So I think these are the very important steps. And I know each of these agencies are wrestling with how to do this, particularly in this cost-effective, easy, and relevance, really bringing them all together. That's not something, and again, this is where I think collective learning and approaches could be really helpful for the DFIs.
Yeah, absolutely. I'm looking at the questions at the same time. Another question that, well, it's I would say connected topic, but we haven't touched on it one. So curious on your thoughts around results-based financing mechanisms versus impact investment vehicles. Of course, there are pros and cons to each, and there are appropriate circumstances for each, but interested in your experience and views on results-based finance models in emerging markets. What are you seeing, and what are your views on them? Has any one of you experimented with results-based financing and or invested into RBF funds or outcome-based funds?
Christina, BII, maybe a couple of quick comments from me. BII has made an investment into one of the, I think, first results-based finance funds, looking at sort of trying to build a portfolio of results-based finance investments managed by Bridges Ventures. It's still, I guess, early days to know the results of that fund, but the asset class as a whole is sort of 10 years old, and I think as last time I checked, a couple of hundred plus six kind of individual results-based finance contracts. I mean, I think they're very interesting and very good at tackling specific outcome gaps and outcome problems. I think the challenge is always less in the investment and more in the sourcing the outcome payments for the business model, for the model to work. So who provides those outcome payments? And then I guess the other challenge is in making them less bespoke and kind of tailored, and which adds a lot to the kind of setup costs. Because I don't think we've seen any yet that have got sort of truly big. I mean, yeah, compared to where they were 10 years ago, there's been a huge amount of progress, I understand.
Yes, I think that that's a great conclusion. And yeah, good to see that you have been one of the investors in the UBS Bridges Fund. That they have been really at the forefront of developing this mechanism in the various markets. But they're probably feeling a little bit alone at the moment. It's an interesting question to follow in terms of trends. There is, well, I guess you also touched a little bit on it, but I would like to bundle two questions in one around where you see the most traction, perhaps, for the private sector to invest. So the two questions are, what are some of the most compelling value propositions for private sector to invest in terms of geographies or business development, for instance? And well, it's a slightly different question, but still related. What have you found is the staff capacity for private sector to engage, develop and implement these investments and partnerships? To what extent do they want to be involved, or are they ready to implement such opportunities?
I mean, I think from our perspective, there's huge interest, and it's not terribly organized yet, but we see tremendous interest from large asset allocators and managers to really participate with DFC and very much in emerging markets and infrastructure and climate related finance. These are areas that I think all investors are hungry to place capital and to have that capital, unlock local opportunity and potential. So we are, working through some of these agreements ex ante to see if we can start to partner more specifically with some of these larger capital providers in ways that are not just one-off, but more strategically organized around infrastructure in geographies and specifically often related to climate. Yeah, this is something that's new on our sort of origination front, but very potential, we think. And the other way we're trying to crowd in more private participation ex ante is by banding together with DFIs. In Latin America, we have a new strategic partnership with the Inter-American Development Bank, their IDB Invest, their private arm, to really see if we can collectively do that outreach to some of our likely private capital participants. So I think there's a lot of renewed interest. I think the World Bank meetings in April sort of galvanized a number of conversations, particularly around private capital mobilization and what are the most effective ways to crowd in private capital. And the flip side of that is that we saw a lot of capital providers coming to us with sort of new interest in how to engage in ways that we haven't seen before.
Right. Well, that's really exciting. And yes, that's what we're kind of feeling as well. It's probably an intuition at this point, but that investors are really wanting to engage. Do you want to comment on this one? And I also have another question for you from someone else. So on your local currency approaches, please advise if there's a different approach by FMO for local currency SME financing between regular FMO capital and the massive program. So if you can take both questions in one.
Yeah, so maybe first to then what Elizabeth was just alluding to, we also see the increased appetite for it. We have at FMO, we have a different department looking at institutional investors and private capital mobilization, FMO investment management, and they are doing some great work. Recently they launched that SDG loan fund, but also already have several funds where they attract commercial and institutional investors to go hand in hand with us in funds to invest in are more successful in large scale investments across our focus sector. So that's how we go about that. And then on the local currency financing, there is a difference between regular FMO capital and a massive program. That's massive program. Maybe you remember, but I briefly mentioned it during my introduction. That's our financial inclusion fund that we manage on behalf of the Dutch government. It's concessional finance, and because it's a pretty large fund, it's 500 million euros. Massive does not need to hedge local currency; it can just give it out. Whereas if FMO does local currency financing, which we think is important and we do need to hedge it, and we work with, for example, TCX to do that. So that's the difference.
Thanks, Wendy. And great that you're mentioning TCX as a big solution for the local currency hedging. It's one of the best solutions that is working today, and I hear that they will have more resources in the future to keep doing the work that they're doing. Well, there's many questions in the Q&A, so I'm actually going to pick one that I'm curious to hear from you guys, the panel, on the role of technology. We touched a bit on it slightly, but will be great if you have any examples or things that you're seeing in the market that are interesting. Do you see a role for tech for good, AI, in driving changes in capital deployment for SMEs? Drew, I know that some of your capital providers have worked on innovative models. Do you want to say a few words?
So one of the important segmentations to be considered when we talk about small business finance is there are 2 or 3 major needs of monies. One of the most important ones is working capital for small businesses, just to get their businesses going. And that is a big part of it. The second really is the need for what we call growth capital. And this is, I think, the fundamental issue for when we talk about the development impact. It's nice to have businesses kind of roll along and survive. And that's what working capital can do. The growth capital becomes the one that really takes them to the next level, can really allow them to be the kind of companies that I think Matt mentioned earlier on, that become the next big companies. And so we need to be mindful that those are 2 very different needs. Where AI plays in really, really well is in its use for more of the working capital, high turnover, faster use of funds situations. And analytics in there. We are seeing a number of funds do this. And what's also interesting, we're starting to see, we'll see whether AI picks up on this, but for instance, on the gender finance side, is if you use traditional metrics, did this woman run a company before? Well, in 99% of the cases, they didn't get that opportunity before. But using alternative credits methodologies, which is now being investigated by a number of the local players, and then I think AI will then be the layer on top of that, is ways to start to drive more capital to people that were under access before. So AI will play a great role for the working capital. We'll have a limited value at this stage because a lack of data is on the more growth capital, which is still the biggest and hardest segment for these small businesses to acquire.
Thanks, Matt.
Yeah, just a quick example that sort of gives color to Drew's comments. BII is invested in I guess a digital lender in India called Indify, which uses I guess non-standard information such as as scraped from sort of app usage, I believe, and that it uses that to improve its knowledge of the underlying borrower to the extent which it doesn't need to ask for a collateral when making loans to SMEs. I think SME finance experts would say the inability to stump up collateral is one of the big barriers to many SMEs taking on conventional sources of finance. So I guess it's just one illustration of how technology and digital innovation can help break down the traditional SME financing barriers.
Yes, absolutely. Thank you for this last example. And while I'm looking at time, I know that we can go on, and we have plenty of other questions in the Q&A. We'll try to kind of capture those questions and make sure that in the next, whatever communications and engagement, we can provide people with answers and views. First of all, I want to wholeheartedly thank all of you as our panelists, presenters, leaders, working alongside us on these issues. So thank you so much for your views and insights today. I also want to thank everyone who joined this meeting and who are still with us at this moment in time. So I would like to ask you as next steps to fill in our 5-second survey. But I also want to address one of the questions that was mentioned in the Q&A about next steps for our working group. So we have a wonderful advisory group for this working group with the 3 co-hosting DFIs and a few other experts. So with them, we are designing the agenda for the launch of the working group. So we have invited a number of DFIs, public development banks, investors, experts to join us and to work with us on what works in private capital mobilization and how can we implement those successes in the current operations of DFIs and make recommendations on other aspects of practice. So this is an 18-month project that will run until approximately summer next year. The first perhaps invitation to all of you is to join us for conversations about these topics at the Africa Impact Summit, which will happen in Nairobi, hosted by the African national partners of the GSG. It will happen in July, on the 17th, 18th, and 19th of July. You can find the information online. We will send also a link to that summit in the follow-up. We will send the documents, so the presentation that we had today, as well as the documents that were mentioned by the panelists as a follow-up, and the recording link for anyone who wants to listen or listen for the first time to this meeting. So again, thank you so much for being here, for joining us for this conversation, and we hope that we can count on you to continue collaborating and sharing learnings on these issues in the future.